I'm Harper Jones. Know a bunch of you guys in the room. Talked to about everyone. There's a few new faces. Looking forward to talking to you guys. My company is Life with Leverage. We coach people on the infinite banking concept. How many people in here have a policy? Can you raise your hand if you have a policy? So it's like 60, 70% of the room, which is awesome. We're all coming together and hearing about it. But disclaimer, I'm not a CPA or an attorney, so I got to put that in there because we will talk about some things up that alley. Yeah. Infinite banking was discovered by a guy named Nelson Nash. He wrote a book a couple decades ago called Becoming Your Own Banker, and he showed how whole life insurance, properly designed, is an ideal place to sit cash and then go access it when you need it to finance things in life, which could go from buying a car to financing your taxes or property taxes to real estate. Here are some different ways that we are using the policy. At the top, you see it's up in orange, forced savings vehicle, pay yourself first. You could guess where I got that from, but Todd has taught us that paying yourself first or forcefully saving is really what you need to do before you go invest. You got to have capital before you go invest. You got to.
We need to be able to do that.
We need to delay some gratification, obviously, to get the cash to then invest it. When we put money into these policies, a lot of people ask me, how are we using the policies? How do I use them? How do other people I work with use them? So here are some examples. You can borrow against your policy and use it to finance a down payment or an entire project. Say, for example, you had a real estate project that's a fix and flip. You could just borrow from the policy. You could fund the deal, fund the renovation, and you could either refinance out your capital, pay your policy back with interest, and hold it, or you could sell it off, right, and then recycle and do it again. People will lend money. How many people in here lend money? 1, 2, 3, 4, 5. People can borrow against their policies. Then they can lend the money. Their dollars are earning money in two places, the policy, and then when they're lending. Great place to sit reserves. A lot of people are like, hey, I got to have liquidity for the businesses. Or me personally, where do I sit it? I got to keep it liquid. I can't go invest it. I need access to it, which could also go into property taxes, insurance premiums, or personal taxes. You can't go invest that because you need it to pay those bills or you need it to be liquid. So where are you going to sit it? A lot of people might sit it in a checking account, savings account, a money market, and I'll show later in the presentation comparing a high yield savings account to a whole life policy and how it'll outperform over time, visually and with numbers. Really good later in life. I've talked on it before and shown some people in the presentations I've given individually over Zooms is how when it's funded over a period of time, later in life, the way that these insurance contracts are treated, you actually can borrow against the policy later on. It's compounding in a manner that offsets all the interest when you're borrowing, and it ends up supplementing income in retirement, or it could be a passive income vehicle that's tax-free. Then, of course, you'd still have a death benefit, and those death benefit proceeds would pay off any of the outstanding loans you borrowed, plus interest accumulated. The rest would go to your next generation family charity, income tax-free. That makes sense, what I'm saying there? And then we have Ruben, right, talking about estate planning. Not sure he will touch on this or not. I'm sure he's utilized these strategies, but life insurance is a great way for estate planning, for liquidity events, and things of that nature, and can be very powerful to make sure that your family has liquidity, your business, or if you move the policies later on into trust, that would get it out of your estate so you don't have to pay those estate taxes depending on where you're at net worth-wise. Okay, platform versus process. These are the examples I came up with. Bench press and a hammer, right? That's a platform, that's a product, but really the process would be, hey, building muscle, building the house, right? So we got to separate the two, which parlays into saving versus investing. Savings is more so the pool of money that you can easily access, you rely on, very liquid, and you got to be able to get it quickly. Otherwise, if you can go get a good return or you need the cash, but it takes weeks to get, well, it's not very liquid, so what's the point, right? 401k. Where's Todd? Oh. Investing is more strategic act. What do you say? Investing's more of a strategic act where you are putting money to work in a business. You don't know exactly when you may get it back. You're going to get more of a multiple in, say, equity growth or cash flow, but there's more risk with it, and that's okay, but you're getting more upside for doing so. The platform we use is, or a self-pay account would be the ideal savings vehicle to warehouse that capital or that wealth. Well, the next logical question to ask would be, what's the ideal attributes or characteristics of that ideal savings vehicle? This is what I've come up with, but this can be an open dialogue conversation here. If I'm working hard for my money, these are some of the attributes that I would like in my savings vehicle. I work hard for my money. I would like a competitive rate of return. Definitely want it guaranteed. Definitely want it liquid, because if I have a good opportunity, go make 20, 30% on my money, which does happen from time to time, you need to be able to access your cash. I would like it to be leverageable. What do I mean by that? I want to be able to borrow against it in a manner that I have control and that is not going to cost me an arm and a leg in interest. If it can be tax-free, that's great, because even if it compounds at not as high of a rate, if you're not paying taxes, it's very powerful long-term. Creditor protected, this can vary state by state. More so, another way to say it would be litigation-proof. If you were to get sued, depending on where your cash is sitting, it could be exposed to creditors. Whereas in these insurance contracts, it's much more protected. And then compounding, we don't want it to get interrupted. So we want it to be uninterrupted compounding. And it can get interrupted various ways. Removing it from wherever it's sitting, or from taxes that you got to pay, whether it's out of that account or elsewhere. You guys have any questions? Anything you guys want to chime in on this?
There's not too many vehicles that cover even a fraction of those little all.
No, when I think about it, you got, for savings vehicles, let's throw some out. You got money market, right? Savings account.
High yield savings.
High yield savings. Someone would be like brokerage account, but that's investing. It's not savings. And they will check those boxes, but not all of them. So these are some questions I had. So like, who here uses a savings account to sit cash before they pay expenses, anything? Basically everyone, right? Or maybe a CD, but then it could be locked up for 6, 9, 12 months, right? That was my little joke, but I already did it earlier. CPA, attorney. But anyways, who here has a high yield savings account where you get maybe 3, 4, 5%? Is anyone getting that today in this environment? So we got 1, 2, and typically you're going to have a more aggressive amount of liquidity to be able to get them to give you that return. Now, are they going to do that over decades of a period of time? Maybe, maybe not. But that leads me to comparing a savings account to whole life policy. So first off, let's look at the different attributes between the two, and then I'll get into the actual numbers, and then we can open it up to more dialogue from there. So a savings account might have a competitive rate of return. A whole life policy definitely has a competitive rate of return. Savings account can be guaranteed, but you don't necessarily have predictable growth every year. The cash could be guaranteed sitting there, but you're not going to get 4% year over year and know that for 30 years because they're going to change it on you up or down. A whole life policy is guaranteed over a long period of time. Savings account, whole life, both liquid. If you have money in a savings account and you want to borrow against it, so you say, hey, this is compounding. I want to let that compound, instead of withdrawing and stopping the compounding, I would like to borrow against it. How do you do that? Okay, you're going to probably borrow from the exact same bank where it's sitting. They might let you borrow close to 100% per se, okay? But who controls the line of credit? And then who has to renew the line of credit each year? You or them. Also, are you signing a personal guarantee or is it non-recourse? And then if they're paying you, say, 4%, what do you think that same bank's going to charge you for that line of credit? 7, 8, because they got to make money. They're a business, and there's no problem with that. But if we're looking at what the alternatives are, we got to take that into consideration and face reality. The growth is taxable, so if you're making 4% and your tax bracket is 25%, you're only going to net out 3% growth. It's exposed to creditors. The compounding is interrupted by either withdrawing or by taxes. Like I said, bank controls line of credit. And while you could supplement income and borrow against it later on, like I talked about with the whole life, it doesn't work in the same manner. It doesn't work as well. If anyone ever wants to look into that, I can talk to you one-on-one and show you those two, but I don't want to go too long-winded in this presentation. So back over to the right, the whole life policy, you think a little bit differently, and you're like, okay, this is a little untraditional, but look how many attributes you get. You get the competitive rate of return. It's guaranteed. It's liquid. When you borrow, you're borrowing at 4 to mid 5% today. It is tax-free, credit protected, compounding uninterrupted. You unilaterally control the line of credit, and they can't call it on you. And then it's a great vehicle for drawing passive income or supplementing income later on in your life. Anyone have questions on this? Okay, so here's what we got. We got scenario 1, and I'll dive into the scenarios. So I got scenario 1, 2, 3. Scenario 1 is I'm taking a high yield savings account and I'm comparing it side by side to a whole life policy over a 30-year time span, okay? Scenario 2, not illustrated on this page, is the same thing except we're going to borrow against each vehicle and do the exact same investment over a 30-year time period. And how does that perform? And then scenario 3 would be withdrawing, investing the money, and then once the investment pays back, putting it back into the vehicles, right? I will visualize that, run those numbers in scenario 2 and 3 later, but we're just going to focus on scenario 1 today. So scenario 1, we got on the far left column, end of the year, we have recap years 1 through 10, then we skip to year 15, 20, 25, 30. The way I did it is we're putting cash into a savings account of $50,000 a year for 4 years. Then we drop down year 5 through 10, $20,000 each. You guys following? On the right side, it's the exact same. I'm going to point, but here, second to the right, or second from the right column, cash into policy, that's what we put in, okay? We stop putting cash in both the savings account and the whole life policy after 10 years, okay? In the first year with the savings account, if you do not have the whole life policy, the exact same death benefit you would have with the whole life policy would cost you $2,430 a year. Okay, and I ran that with the exact same insurance company, all right? This is a term life policy over a 30-year period. Someone may say, I don't need that, I don't want it. Okay, but if you're comparing the two, you got to factor that in because this is the most realistic scenario. So if you put in $50,000 and it's in a high yield savings account growing at 4%, let's just say you're in a 25% tax bracket, which might be conservative, you're going to net out 3%, but you got to back out the term cost. So you have $50,000 less the $2,430, and then you compound that number at 3%, and you get almost $49,000. The reason it's less than what you put in is because you have the cost of the term in the beginning. Okay, you guys following? The right side, you put $50,000 in the policy, you have the death benefit already, you have those ideal savings characteristics we talked about, but what am I going to say here? You got to delay gratification. Capacity for sacrifice.
Come on, people.
Yeah.
Lunch is over, clearly.
So you might have, so you might have 31,000, okay? And these are actual values I'd copied over from a policy with companies we use. But you're like, okay, well, why would I do that? Why in the world would I do that? It's like, okay, well, if you can think past tomorrow, you see the benefits, right? So year 2, you do the same thing. All said and done, you got a touch under 100. And over here, you got like 78, okay? Year 3, 4, 5, look at it. And it's like, okay, you got 151 to 125, 204 to 175. You're like, okay, it's getting a little closer. Well, let's skip down to year 10, okay? You're putting in your last 20,000. You have 362, and over here you got like 345, okay? Keep in mind, you can access all this, borrow against it, not stop the compounding at 95% loan to value and pay 4% interest, okay? If you're going to let this compound over here, not withdraw it and borrow against it, what are you gonna pay the bank? 7.5%, 8%? So if you factor in the actual use of the cash, which is most likely gonna be reality, this will actually start breaking even earlier. Does that make sense? Because your cost of borrowing is higher over here. Now skip to year 15. We have $406,000, okay, in the savings account, and we have $438,000 over here. What's happening? Well, if you see at the bottom left, you're the customer of the bank here. If you want to be the customer and you want to maintain access to all your cash and every dollar right away in the beginning, that's your route. I'm not stopping you. You can do whatever you want to do. Over here, if you delay your gratification and you make the investment in yourself and in getting the policies, you're going to start outpacing. By year 20, it's 458 versus 556. Year 25, 517 versus 7. And then year 30, 586 versus 871. You get 50% more just by flowing it in a different vehicle. All you have to do is delay your gratification primarily the very first year. And then after that, you start really growing
Pretty much what we want to.
and compounding. Yeah, correct. So anyone want to chime in? Any questions? Todd, do you have something you want to add to that?
Is that 4% a cost from that's charged by the insurance company, or is that 4% get paid back to your cash value?
Okay, so the question is, when you borrow, the interest that you're paying when you borrow from the insurance company, where does it go? How's it attributed? Okay. To clarify, this illustration is just putting money into each account, savings account, whole life policy, not touching it, not borrowing it.
Yeah,
Okay.
no usage whatsoever.
When you do borrow from a whole life policy, you are borrowing from the same institution, in this case an insurance carrier, same one that your policy's with. When you borrow from them, you're borrowing from their pool of money, okay, and you can get up to 95% loan to value against your cash or your equity, your account value within the policy, okay, in the form of a line of credit called a policy loan in the insurance world, okay? Your cash never leaves the insurance contract, which means you're borrowing different funds than what's in your policy because it's not leaving. Your policy keeps growing and compounding with interest and dividends tax-free 24/7. You get a line of credit, policy loan in the insurance world, against it, and in this case, the interest rate says 4%, okay? When you repay that interest, it goes to the insurance company because your cash never left. It's no different than if your money's in a savings account and you borrow against that. Same concept. Does that answer your question?
Yeah, offset it still by the growth pretty much you get, so it's kind of like a small fee, marginal fee.
Well, you got to think about it this way. We are using insurance contracts with a life insurance company that's a mutual company. So there's stock companies and mutual companies. The only difference between those insurance carriers or those companies when they're stock or mutual is where the profits and dividends of the insurance carrier is attributed. In this case, we use a mutual company, and it means the profits are mutually dispersed amongst its customers or his policyholders, which would be us. So when you do pay that interest back, it ends up going to the bottom line of the insurance company that, guess what, you are part owner of. So it indirectly does go back to you. But they have a balance sheet that's invested in numerous different things because they got billions and billions of cash. And why the interest rate is so much cheaper is because they don't have third-party stockholders to have to please, because it's all going amongst the pool of us.
And those indirect returns are from dividends?
Say again?
The indirect returns, are those from dividends?
Yes, it'd be from guaranteed interest and dividends. So just like at a bank, a traditional bank, a Wells Fargo, Bank of America, the customer will get interest on their deposits. The owner is going to get the dividends, tax benefits, the equity buildup, which we do not get because we don't have shares in that bank, right? An insurance company operates virtually identically to how banks operate. They take in cash in the form of premiums, okay? Those premiums, they have to put to work or loan out to different massive real estate developers, corporate bonds, treasury yields, policy loans to us, because they got to have that return profits, because they're a business, that then go pay out expenses, just like if they're financing car companies or car insurance, property insurance. This is life insurance, same thing. They got death benefits, expenses, commissions they pay out. Well, it's all got to work. And so the money comes in, they loan out the profit, comes back with interest, and they're repaying all the people that are policyholders. The only difference is there is no third party trying to profit, it's dispersed mutually.
Yep. So the exciting piece for me is when you start using it.
When you start using it, it becomes much more powerful. I don't have that illustrated specifically with numbers, but I think this is a great time to, you want to share how you've used yours a few times?
We can use some examples. And
Talpis, we can talk about the buy, sell, you and Dusty setup and the kids' policies, if you want to chat about that. And then anyone else, I mean, literally 70% of the room has policies and they've almost all borrowed against them and used them.
You want to come up and talk about the buy, sell, and the
Almost
kids
all.
stuff, actually? There's an extra mic on the side of it, so as long
Yeah,
as
you
you
just kind of
stand near
stand somewhat close.
Yeah.
Check 1, 2.
You got the thumbs up.
Yeah, kids' policies are probably my favorite thing with this whole life stuff. So I'm using it more as a vehicle to teach my children how to use money and how to do it correctly. So, do you have one of their?
I don't have one of theirs pulled up.
You got a kid on there, though, age 8. Okay.
Yeah.
What's that? 10,000.
You know how to walk through that?
Yeah.
10,000.
So mine, I got set up for all my kids is 12,500. And when you're a business owner, you can actually pay your kids as like employees, so tax free. So I get to save on $36,000 worth of income. I don't have to pay taxes on because I pay them and I pay it into their whole life policy. So instead of having checking accounts for all of my kids at the banks or some college fund, I've chosen the route of the whole life for the kids. And this, like when they get older, these policies can be gifted to them if I so choose. If they're going to use it correctly, and when they're ready, they might get a nice little gift.
Are you so worthy?
Yeah. So I got 3, so I'm guessing one's, we're gonna have trouble with one, I'm sure. So I'm hoping she'll see the other 2 get their gifts and be like, I better straighten up a little bit and learn this shit.
They got how much?
Yeah. Yeah. So the kids policies are crazy. Like the numbers are really crazy on there. I know, like when my kids hit like 60, like retirement age, like I'm putting in the 12.5 every year for
12,500.
Yeah, for 10 years, and then it drops down to 5,000. Mm-hmm.
He's doing 10 because kids.
I'm doing 10 because that's when they start hitting like 18 and stuff, and I can no longer pay them. So once I lose my tax benefits, they're gone. Yeah, so I did strategically set it up like that way. Go ahead.
So you can pay them and enjoy those tax benefits while they're minors?
Mm-hmm.
Okay.
Up to 14.6, I believe.
Yeah, I think it's more than 12.5.
Yeah, you need to increase your premium.
Yeah.
You have to be able to adjust the funds then, the work that they do for you, like 2 or 3 years.
Yeah.
You could if they're like on your marketing.
Yeah,
Like, there's ways to get you to do it.
Yeah, my 3-year-old takes pictures for marketing.
They're on your website. Yeah, seal the envelope for you.
So show this. I'll go to this other side.
His daughter's writing letters for him.
Check that out at page 67.
Yeah.
He put in 300.
Yeah.
I'll point that out.
Yeah.
It's a dividend will actually pay the.
The dividend pay, it becomes free after 12 years or something. I think
It was
10.
20, it's another, it was like 23.
Yeah, it was. I can't remember the exact point. Yep.
Is there negative consequences for not putting in the 12.5? You know what I mean? I don't understand there's like policies and stuff. I'm not sure if it's a specific setup, but if you don't pay the 12.5, I don't know if that's considered premium or considered what you have to pay or what you set up to pay, does the account suffer in any way if the payment is not made? You know what I'm saying?
Yeah. So, are you curious if you can pay in less or more?
Yeah.
Okay. Yeah.
Are you allowed? Let's say you have a really good year. Let's say you do 4 more deals than you normally would, and you're like, hey, you know what? I might as well put in. Like, are you allowed to do that, or are you allowed to put in more?
There's caps. There's a cap on it.
Let me repeat the question. So the question is, when you have a premium, in this case $10,000, is that premium entirely set? Can I do more, or does the policy hurt if I were to not make the premium payment or do less? And the answer is there is a range when you set up a policy and how you fund it and how you go about it. This also plays back into not every insurance company is the same, and how they design their policies or how flexible they are or aren't. So with $10,000 in this scenario with this insurance company, your requirement would be 40% of whatever number we chose, in this case $4,000, at least for a period of time until the policy is sustainable. Then we could actually remove the premium entirely if we chose to do so. And then you have a flexible paid up rider, which is 60% or $6,000 for the total of 10. So you have 2 different premiums in this scenario, the base premium required and the $6,000 flexible. So if you were to fund 10 in the beginning, we're designing it to where it's very cash efficient for you, and it's bumping up to what we call a MEC limit, modified endowment contract, or think of it as a ceiling in a house. The ceiling might be 10.5 feet, we're up at 10 feet, okay? So then year 2 rolls around, you say, Harper, I don't have the cash on hand yet. Can I just fund 5? Sure, 4 base premium, and then $1,000 in the rider, and then the $4,000 additional to catch it up to 10. Either could skip, or you could do part throughout the year, or maybe make it up in a new year. But the point is, you can't bump up and get the ceiling and go do 30 grand in 1 year. You would just then need to start another policy, and there's no difference in you having more than one policy except for simplicity, because it's all the same thing. It's just dispersed over time. It's long-winded, but that helped.
Yeah, and then the MEC status of the policy, does that mean that the policy is, like, or is it you're just not allowed to? Like,
you can, if the company allows you, you
You
can.
lose your tax benefits,
Yeah,
and
I guess my question
you're going to see a theme of us of liking tax benefits.
Sure.
So
Yeah. And do you have to, like, do you start again, basically, if you miss that payment, that minimum payment on the premium?
Okay, if you were to not get the $4,000 in, then the only other options is you could surrender some of the death benefit to help pay some or all the premium, depending on the maturity of the policy. You could borrow from the cash in the policy if it's there. And if you really are stressed out and can't do it, I probably wouldn't have done the policy with you anyways, because you guys wouldn't be in that position. But you would just surrender the policy, and that's why they call it cash surrender value. That's your spot price for walking away. So then you'd walk away with whatever cash is there. Now, not the same for universal life policies or other insurance products that are out there. They might have a cash value of 100, but if you were had to have to surrender it, they have a surrender fee, and you might only walk away with 70. And you're like, well, that's shit. But it's like, that's the product, man.
Right.
Yeah.
Yeah, do these also, like you have said in there, they'll have like a no lapse guarantee rider where if like it'll pull basically from cash value to make the minimum if needed.
Everyone words it differently, but like it's called an APL, automatic premium loan. Yeah.
So we have multiple policies, and the reason that we have multiple policies is, you explained it a little bit, but like in the first 4 years especially, we're trying to get as much cash into the policy as humanly possible. So we have what's called a paid up rider. And once the paid up rider is funded, that actually falls off. Okay, so let's say the example he's using was 10 grand. So if I'm going to put 100 grand into it every single year of one policy, 60,000 of that is going to fall off after 4 years. So every 4 years, we actually create a new policy to continue putting funds in and maximizing it.
You want to go through this slide?
So we do. Todd funds his diligently and builds wealth along the way. Let's look at how he can supplement and go, hey.
So this is on you.
Oh, okay, yeah, there you
This
go.
would be
There's a
an
perfect
example.
example. This is one of ours.
Now I'd have to zoom in, but show how you
Look
fund
at that
the
preferred
beginning.
non-tobacco. Look at that.
I'm not quite sure you get that high of a health rating, but
That's not a plus.
That's what I got to do. Yeah,
all right, this is really cool. I got to touch on
yeah,
this.
these are real numbers.
So this would be real numbers, right? So for example, can you guys see this a little bit better? All right, fine, I'll stop moving it. So you put in 100,000 for 4 years, we drop down to 40. Why do we do that? There are two different premiums I said, a base premium and the paid up rider. The paid up rider acts like fuel on a fire or turbo in a vehicle, okay? And the base premium's horsepower. So once it gets accelerated, we drop it and then we let it ride, right?
Yeah, it's funded at that point.
So-
It has momentum.
Todd puts in 100 for 4 years. Year 5 puts in 40 through year 70. Okay, I guess this would be age 70, so 33 years. He has contributed 1.56 million over a 33-year period, and then stops contributing. Keep in mind, at this point, he's been able to borrow against it, access it the whole entire time, more so over and above the basis he's contributed. But this is where it gets really powerful from another perspective, is from age 71 to age 90. Keep in mind, he's put in 1.56 million in premium. That's his basis. We start borrowing against the policy, repaying zero interest, letting the policy loan or the loan balance have the interest accumulate with it for 20 years. So as you can see, cash outlay here, this column, over that 20-year period, we are taking 2.44 million. Okay, or sorry, right here, my bad. 4 million bucks, 20 times 200, 4 million bucks, we pocket, pay no interest, no principal back. We still have 1.3 million in cash in there.
No taxes.
And if we were to die, 2.4 million goes income tax free to a charity or the beneficiaries or the kids, and it wipes out and extinguishes the whole loan we had here. So you put in 1.56, you pocket 4, and then you send 2.4 to the next generation of the family. No taxes. Yeah.
You're gonna see a pattern with me. No taxes.
So
I
that's
got tired of buying the IRS Ferraris, so I'm like, I'm gonna figure this
That's
out.
like a 5x of what you contributed.
To 90.
Yeah, hell yeah, baby.
Don't die when you're 30.
Yeah. See those numbers? I don't know. Yeah, I'm gonna leave all that on the table.
I mean, Todd, we can add whatever, but I don't want to get too deep
I have a
into.
question for you, Harper.
Yeah,
Say I do not have a whole life policy.
but you do.
I'm just saying. Say I do not have a whole life policy, but I have a one-time windfall, say an inheritance or an insurance payout or something like that, and I want to take that money. Let's just say it's like $200,000. And I want to take that money and put it into a whole life. But it's a cash in my pocket. How would you go about advising me on how to do that?
Okay, so this is where when you're establishing a system, you have a system of policies over time, which you guys do with the family, the kids, and yourself. Over the years, you're going to have hundreds and hundreds, if not millions of dollars of cash value. The likelihood that the cash value will be 100% paid back and not loaned against at all is very low, right? Because money is always flowing back and forth. So in reality, you might have $1 million in cash value over the years. You might have loans of 600 against it. So then you have $600,000 of room to pay back outstanding loans, which is where you could plug the windfall in. Does that make sense?
Yeah, so you're saying I would have to have a policy already started.
That's one scenario. Another scenario is you expand and open more policies and more premium, but you can't just at one time put in 500 and then stop contributing. It's got to be dispersed over a period of time, which there's no problem with that, but you just kind of get it in there slowly over time. But that's also a good way later on in life, if you have these big loans outstanding, you know you're going to get windfalls from a refinance, inheritance, maybe a sale, stuff like that.
Yeah.
Right.
And throw it back in. There's like no requirements to access like your money. Can you go into that like that?
Who here is taking a policy loan? Raise your hand. How long did it take you to get the proceeds from you guys texting or emailing me?
Yeah. Yeah, you sign a doc. That's it. There's no application period.
What was there
No,
any
no,
credit
no.
check?
Nope.
What do you guys have to do?
A text Harper.
So, yeah, gimme.
Shows up.
Yeah. Gimme to bank on a
You
file.
sign one document.
Guys,
Yeah.
it's so easy. I can do it. If I'm telling you.
He learned how to put an attachment in an email the other day.
Yeah, just yesterday.
So we use like one of the ways that we
You
really
have to tell him about the buy sell after he's done.
Yeah, I was about to say, I do want you to talk about the buy sell. So one of the ways that we approach it specifically and why we do it is I use it as a recyclable asset. That's what I care about. Recyclable to means I have money in a space in which it is growing that I have access to, that when I have access to it, it still grows at the same pace. So even if I'm using it, it continues to work in that spot. There's not too many vehicles on the planet that allow that. This is one of them. Another one is technically real estate because you can borrow against it and it's still growing and giving you rent money and things like that. But this specifically is obviously far more liquid. I have the ability to do it without any credit checks or applications or anything. It's literally a text message, as he said, and then it gets wired to you. So what we'll do is we will use cash value out of our policies that is earning, say, 6-7%, whatever it is in this space. Say it's 100 grand, so it's going to earn us 7 grand that year. We'll take that 100. We'll also put it into a building, and the building will earn us, so 100 grand's a $500,000 building, right? With leverage, because leverage outperforms ability always. With leverage, that building might make us it might net us another $75,000 a year. So this 100 grand managed to make us $182,000 while working in 2 different spaces. And then whenever I'm finished with the project over here and we sell it, liquidate it, move it, whatever, we pay the policy back. Then we refund it and we do it again and again and again and again.
Because there's no repayment term.
There's no repayment terms. This is the part that Harper hates that I'm going to say, okay? I'm going to say this. You shouldn't listen to me, you should listen to him, okay? I never pay our policies back. I was literally inhaling to say the next part. Anyways, I never pay our policies back until our project is done. Okay? So like, let's say I have a major project coming up. I'm like, all right, I'm going to take $500,000 out of our cash value and I'm going to put it into a $4 million building. I'm not making payments on that 500 grand, okay? Because I own the policy, so I can set up my own terms, right? When I'm done with my project and it sells and we're profitable, whatever it may be, and I get that liquidation back, I then pay it back. Harper has a better way, which is make sure to pay your interest payment at your annuity time, at your annual time. It probably makes more sense, and it's safer, it's better protection. I get that. But just to give you like the level of control that you have, I never pay ours back until our project is done because I'm focused on the projects. And then I pay them back. But I always pay them back. I don't rob myself for 12 years straight. But we'll have projects go 2-3 years that we might have a few $100,000 out of a single. We have multiple policies. Out of a single policy, we might have a few $100,000 out in a project, and then when the project's done, we'll pay it back.
They can't call it on you legally.
Yeah, it's your cash value.
Speaking, they cannot call it on you.
As long as you have enough money in there to cover the interest rate.
Correct. Or you at least just pay the interest at anniversary each year. That's it. Which is the wise thing to do.
Please do that.
Which again, listen to him, not me, but that's what we do.
Yeah. Yes, you can write the interest off if it's used for a business purpose, but check with your CPA.
Yeah, so that's how we use it. So we use it in a multitude of ways for business, real estate, investments, anything like that. Like whether it's going to have, as long as it has the ability to pay itself back, and like, because I want to buy it. My whole vision is buy value at a discount. That's it. If I can buy something that's 200 grand for 140, I'm going to do it. If I can buy something that's 500 grand for 380, I'm going to do it. If I can buy something for $4 million for 3.5, I'm going to do it.
If I can get 2 meals at Chili for the price of 1,
you're going to do it. You're going to do it. It's a 2 for 1. Yeah. Value at a discount.
I guess the way I would simplify this is you are already having money going into essentially a savings account in and out of that, paying expenses or investing it. If what I showed you outperforms what you are currently doing, and then enables you to do what you're currently doing better, then you got to ask yourself, why not do it? And that's a question for you. Is, well, Is it my thinking? Is it I don't want to delay gratification?
So your
what is it?
capacity for sacrifice?
Yeah, and that's why I wanted to put the actual numbers out because I'm like, it outperforms it. Like it's just the facts. It's just the math.
Is there a cap on how many policies you can have?
You're only capped based off what's called your human life value, which is a multiple of either your net worth or your annual income, depending on age. And then that would be a different premium for every different person. But the amount of policies doesn't matter.
And you
Let's
can
say
own a
get-
policy on people you have collateral with. It doesn't have
Yeah,
to be
so I
on
got
you.
like 4 on. I got my brother, other business partners. He actually has a policy on his business partner, Dusty, cross purchase. So in the event one of them dies, it buys out the business partner's interest immediately, so they're not partners with their spouses, and gives them a step up in basis in the business.
And funds the whole purchase without having to take it out of your ops account.
That's correct. Yeah.
Your partnership.
Any other questions?
Yep. That's how we create liquidity events with cash value.
If you guys have any other questions, want to talk, most people have my contact, but it should be in the flyer too. I'm happy to talk more one-on-one, or if you want to look at kids' policies or want me to look at your own policies or anything like that. So, what do you got?
Can you explain again, like the protection, the benefit for terminal illness, chronic illness, and critical illness?
I should probably add that in the presentation. So you have a death benefit, right? And we're all aware of what the question is. There's additional death benefits with a policy. Specifically with the death benefit, I was asked to explain the acceleration riders, where in the event you had a chronic, critical, or terminal illness, you actually, instead of just borrowing from the cash value, which may be $250,000, your death benefit might be $2 million. You can actually accelerate the death benefit while you're living, grab it, tax-free, and then go use that for the expenses, right, of you being in the hospital, cancer, whatever that may be. So that's actually really cool.
I had a real life case study of that. Do you mind?
Yeah, sure.
As an agent. But we had a former agent that had a couple of policies. I think these might have been terms in the whole life, and $1 million policy. He got like a stage 4 cancer diagnosis. It was a really rare stage. They basically told him like, you're not even treatable at this point. He accessed $990,000 of his $1 million policy from his accelerated living benefits. Took that, went to an experimental treatment up at like CU Hospital, and as basically cancer-free remission. Got to see his kids live and graduate high school. Didn't work for 3 years, spend time with them, and the healthcare system basically had wrote him off. And because health insurance doesn't pay for experimental treatments.
Yeah, where would he get that money?
He literally got it in 2 days. Took his family up to Colorado from Arizona, and he's now cancer-free.
Okay, this might be a morbid question, but didn't the insurance company want him to pay it back since he didn't die?
No,
I'm sorry, is it too low?
no, because he just basically doesn't have that $990,000 when he does.
Got it, okay,
Yeah.
alright. So
Insurance policy.
Mhm.
it's just deducted from the,
Yeah, deducted from the
Mhm.
benefit.
And it's tax free.
But you have to understand as well, the insurance company.
Don't forget the tax free part.
The insurance company, technically it's tax deferred, but tax free if handled right.
I believe so. In an accelerated event, do you still have to continue paying the premiums to the end of the original contract, or is it?
Okay, so now the question is, if you were to have that trigger and borrow from the death benefit to pay for those expenses, do you still have to pay the policy premiums and whatnot? The answer is it depends on how it's set up and if there are other riders and things of that nature. I think at that point it's getting a little advanced, but one-on-one, I'm happy to look at the different options.
You're happy you're 11 at that point.
Yeah. But once again, the premiums,
$140 a month. Like,
you have
Seems a
engineers,
little-
which are called actuaries in the insurance world, and engineers always overbuild things, and they've done the same thing mathematically for law of large numbers, which is us who have policies, right, and on our health. So they have it baked into the premium as a whole, dispersed very small increments amongst all of our premiums in the event that happens. So it's like it's all built into the system. So like they expect those things to happen. They say, oh, someone might need to accelerate their death benefit and have an extra $1 million or $2 million. 10 times a year out of millions of people. So they just bake it in. So like they expect that to occur. And if it doesn't, they issue a bigger dividend at the end of the year that disperses to everyone.